Hard money loan worst case. Today we're going to be talking about what is the worst case scenario if you went and got a hard money loan. A few days ago, I was talking to somebody and he's like, hey, I really want to get started in doing this real estate investing, but I really need to know what are all the things that can go wrong? There's so many of them and there's ones I haven't even thought of. But what we have done is over the last 22 years, we've learned from our mistakes and other people's mistakes to build the system that we have so the mistakes that have been made in the past don't get made again, which is one of the big benefits that we have with our organization is we've systematized the approach to eliminate it. So literally you're 20 years ahead of where you would have been because you've got the collective knowledge that has came from lots of different people and the organization itself. Now, let's talk about worst case scenario. So let's say that you go and you get a hard money loan. There's a couple of different ways that this could happen. You go, let's say that you're buying a property for $100,000. Let's say that this is the purchase, and let's say the rehab's $40,000, and let's say your interest, cost, title fees, and all that. So you're into this $160,000. Now, depending if you got a 100% financing loan, which you can get for the purchase, the rehab, and the closing costs, then this property would be roughly worth, let's just do the math, divided by 0.74. So if it was worth, let's just say 220 after repaired value, at a 74%. Yeah, so like 218-ish, but let's just use that number. So if the after repaired value is, let's just call it 215, 74% of that, of the after repaired value would be 160, which means the purchase, the rehab, the closing costs, the payments, 5 months worth of interest, and the title fees. If all of that fits under the $160,000, then you could get financing for that entire $160,000. Through our 100% financing program, which is very unique and you won't find anywhere else out there. But let's say that this one wasn't. Let's say that you needed $170,000 and the max you could get is $160,000. Well, we have a lot of strategies, renegotiating, doing other things to come up with that additional $10,000, other sources of money, you name it. But let's say you've tried all those other sources and in the end, you've got to come up with $10,000. So you come up with $10,000 to close. Well, we're going to talk about a scenario worst case for both of these, where you've put zero money down and also something where you've got $10,000 into the deal yourself. Now, first, I want to make sure it's important that you realize that most lenders are not out there as loan-to-own lenders. A loan-to-own lender is somebody that's doing the loan because they want the property. Like if you mess up, they're going to be happy to have the property. And if that's the case, you want to veer away from those. For us as an organization, we don't want the property. We want our money back and we want a return on our money. That's what we're looking for. We're not looking for the properties. We're not doing loans to try and somehow get the property or take it from you or whatever the case is. That is something that you want to make sure you're dealing with in an organization that is not in it to get properties. And lots of times we're dealing with private lenders. You're going to run into situations like that where they're doing a loan to own, where they're hoping they're going to own it. Assuming that's not the case, you've got to realize the only mission, the goal of this is to actually make a return on our capital with the lowest amount of risk as possible. That's really what we're going for as a hard money lender. So let's say that we do the loan and for some reason you're not able to sell the property. So let's say that we get the property and let's say some damage or something happens to the property. Well, that's the reason why we have hazard insurance. So let's say, the tree falls down and breaks something, then you would go and you'd make a claim against your hazard insurance. You'll probably have to pay a deductible or something like that, but normally that's pretty minor. And then those repairs would get done to the property. So that's one thing that could happen. Second thing that could happen is it could have to do with a rehab. You may find there's additional problems with a property that you weren't anticipating that you couldn't have seen. Now, this is pretty rare because there's a lot of things you can do. You can put a camera down and look at the sewer. You can do pressure tests on the piping itself. You can do a full inspections and get somebody in the roof and the attic and everywhere else. So these should be very These should be very infrequent when you're running into situations like this where you're finding some stuff. Now, what a lot of people do is they'll budget 10% and say, hey, I'm going to plan an extra $4,000 so that I have as a little bit of buffer if something comes up that I wasn't expecting, which is a wise thing to do. Not something that's required, but it's a wise thing to do. So there's that. So if you didn't have the rehab, there may be some additional cash that you'll have to come up with if there's an unanticipated repair that needs to be done. Now, one of the things we do is we have a project manager walk the property with your general contractor on a virtual walkthrough to help identify those types of things and asking questions to try and do our best to not have these unexpected repairs. The next thing that could happen is so this is an unexpected repairs. The other thing that can happen here is just a cost overrun. You're ended up having to spend more money than was anticipated. Well, what we do is we get agreements with the contractors that includes pricing, and we hold them responsible for those pricing. So that works out really well with the general contractors to earn the business and actually tell us what the pricing. So setting that up appropriately is going to save you from a lot of those things. So now we're to the point where we're going to say you've already fixed the property up. You've got the property that's all fixed up. Now, what you're trying to do is you're either trying to refinance or you're trying to sell, right? One of those two things. You're going to refi into a long-term hold and keep it as a rental property, or you're trying to sell the property for a profit. One of those two things is happening. Let's start with the refinance. Let's say that you were wanting to do the refinance. Well, before you started this whole process, you should have been pre-approved for that so that we've got takeout financing all ready to go. So that means they've checked your credit and your income and all those things necessary to get a full pre-approval. That's not required for the hard money loan. That's required for the takeout financing. One of the things people are doing is DSCR, debt service coverage ratio, and that basically you don't have to have any income qualifications. It's basically based upon the debt service coverage ratio. So you've got your conventional way that's going to look at your credit to do a takeout financing. Then you've got your DSCR, which is your debt service coverage ratio, which basically is going to look at the income from the property divided against what the cost will be, and they're going to want to make sure that's a 1-to-1, 1 to 1.2 ratio, meaning the income is 1.2 times the debt service or the expenses with the property. So that's the thing that you can do there. So let's say you were trying to get a traditional loan and that doesn't go through. The next thing you could look at is getting a DSCR loan. Hey, we'll look at doing something like that. A little bit higher interest rate, but a lot less hassle. If that doesn't work out, then you could move and say, now I'm going to sell the property. And put the property on the market and list it with an agent, get the property sold. Now, your plan may have been that you want to sell the property and do a fix and flip. The thing that I find happening most of the time is people overvaluing their property. So when it comes time to put your property back on the market, what you've got to do is look at the market and say, what do I realistically think this house is worth? One of the mistakes a lot of people make is I'll list it for whatever and somebody can make an offer. I disagree with that on every single level. I believe in what's called precision pricing. I think you should list the property within 3 to 5% of what it really should sell for and give yourself 3 to 5% negotiating room and put the property on the market for that amount. Now, can you get more than that amount? Yes, but I'd rather have a bidding war than I would have bringing the price down. What a lot of people don't realize is when I first put my property on the multiple listing service, I get the most amount of exposure. And the longer it's on there, the less interest I'm going to get. So I only have one time to do this. So I'd rather come out with a really good price and get a frenzy and maybe get multiple offers and then go for highest and best and get something that's more than what I was hoping for, rather than putting on it high and over time bringing the price down. We call that chasing the market, where you're always a little higher than where the market is and you're always bringing it down, and that takes time, it costs money, and if you've got a hard money loan, there's expenses to that because interest is not going away, it never sleeps. Okay, so let's say we're going for the sell. You're hiring an agent, you're doing precision pricing, you've put it on the market, and you still don't have this property sold. The next step that you're going to be doing is regular price reductions. So every 30 days, you're going to be looking at this, or sooner, depending upon the feedback. So what should be happening once your property's on the market? So your property's on the market. Your agent should be getting feedback of every person that goes and looks at the property. They should be asking a few questions. One of the questions they should be saying is, hey, are you guys considering making an offer on this property? Is it even one you're thinking about? If so, why? And if not, why? Number two, what did you think of the price of the property? Number three, what did you think about the condition of the property? Number four, what other properties are you looking at? So it helps me understand competition. And number five, is there anything we could do that would make you want to make an offer on this property? This is a very important question because if they say, you know what, if you guys would just tear down the gazebo in the backyard, we'd be really interested in it. Or if you would lower your price $10,000, my people would be very interested in that. Now, I'm not necessarily going to do that based upon the response of one, but once I have multiple responses, then I'm going to take this information and I'm going to make a decision. And the decision is I can lower the price to compensate for some of these things, or I can spend some additional money to fix it. If I'm having multiple people saying the fence is terrible, I would never buy a house like that, and that's the majority of the comments that I'm getting, I probably want to fix the fence. The choice is lower the price and let the new buyer fix the fence, or go and get the fence fixed up, because I'm hearing that over time. Now with that information, if I'm constantly getting feedback, there's one of two things happening here. If I'm not getting enough showings, it means I'm priced too high. If I'm getting showings but I'm not getting offers, it has to do with either the condition or the price. So I can change the condition, and I don't want to change that condition until I get feedback from the agents that have showed this property. But every 30 days, I want to be relooking at this at a minimum to look at the feedback coming from this. Analyze that feedback. What am I hearing? Do I want to lower the price, or do I want to fix the condition? And then based upon that, I'll make an adjustment on the property and on the price. All right, so let's say that you've been doing this and you've been making your adjustments, and for whatever reason, you're not getting offers. Now, I can tell you, this is not very common. If you've done the rehab and you've done it in the time frame and you've been in the budget and you've done the steps we've talked about, this is a very rare situation that we're talking about here. Usually what happens is the rehab doesn't get done like it's supposed to, doesn't get on time, it doesn't get listed like it's supposed to. All the things we've talked about to this point have not happened. So when we get to this point, it's pretty rare. But here's the situation. You're lowering the price, you have done everything that we've talked about this far, and you're still not able to get rid or sell this property, and maybe you're getting to the point where there isn't going to be any profit for you. Well, there's a couple of things that you can do. Number one is you want to be communicating with your hard money lender, letting them know what's going on. You want to be telling them, hey, this is what's going on. You want to be cooperating with them. You do not want to be hiding with them. But what's going to happen is you can come and say, hey, what are your guys' thoughts of doing any type of a short sale? A short sale is where the lender takes less than what they're owed at this time. Now, a lender's not going to do that if you're making money, the lender's not going to do that. So you're basically going to have to say goodbye to the $10,000 you put up. If you put up that $10,000, or if you didn't put up any, then you don't have anything to lose there. And so then it's working with the lender, getting the lender offers. The lender would approve those offers and decide if it makes sense to sell that property for those prices. The other thing that you can look at is what's called a deed in lieu. A deed in lieu is you basically go to the lender and say, lender, I will deed you the property. You don't have to foreclose. You don't have to do any of those things. You take it over and you deal with it, and I'm going to walk away. That's called a deed in lieu of foreclosure. The short sale is I'm going to work with the agent. I'm going to work to get the property sold and do those things. I want to make right on this, but I'm asking if you can make some modifications on that price. I'm walking away from the money that I've put into the deal, and I want to do that because I want to do right by you as the lender and get this property sold for the most we can. But the market has changed or something's changed, and let's get it sold for what we can. And I'll cooperate and be the boots on the ground to help you. So again, communication's everything. The third thing that's going to happen, if you're not working on these and you haven't got the property sold, the next thing that has to happen is the lender, the hard money lender, is going to have to start a foreclosure process. They're going to have to go through taking the property back, because that's the way that they're going to get their money back, is by taking the property, selling that property, and recouping as much money as they can. Now, the lender may choose to sell it as is, or the lender may choose to sell that after repairs and putting more money into the property and doing those repairs. The moral of the story here is hard money loan, worst case, really isn't that bad. It comes to having a plan, moving on that plan, doing things within a time frame, making sure you're doing your due diligence up front, and moving through this process and not getting behind solves the majority of the problems that you may be running into when it has to do with a hard money loan worst case. Now, if you're interested in avoiding all of these problems, you can give us a call. We've got a step-by-step system that will help you, walk you through, and help you avoid these hard money worst case scenarios.